Ben Reppond. Today is Christmas Eve, December 24th, 2024. In my previous video, I showed a couple of pieces from Jeremy Grantham, who talked about his macro view that the market is highly overvalued, and when the market gets this overvalued, historically for over 100 years, what has happened is the market actually crashes and the economy crashes. And but we don't know when that's going to happen. I can't say it's right around the corner, but the higher the market goes, for whatever reason, it does put higher risk, downside risk into play. So I just want to say that, and I'm not a bear. I look at the market both ways, and right now, I want to say, just full disclosure, we are fully invested in the market. Whether the market is positive or negative, most of this year we've been invested in the market. Most of last year we've been invested in the market. So I'm not saying from my own experience and my own investments and my own money management is that that I'm bearish. I'm not. I'm optimistic for the short run. However, I describe it as I have a foot on the accelerator and a foot ready to hit the brake, always. And so, but I do think we are getting to a point where I agree with Grantham that we are getting to a point where valuations are so high and the risk is increasing more and more that the downside is definitely somewhere in front of us. Whatever your strategy is, I just would suggest to you that you might think about having an approach to protect against downside risk. Okay, let's jump into the dashboard and see what happened this past week. This is a picture of year to date and the last week. This is not a pretty picture. When you look at the yellow box, inside there you see that there are seven actually, ETFs, indicators of markets, the Dow, the S&P, the NASDAQ, the Russell 2000, two foreign markets, developed and undeveloped, and then the long-term government bond, ETF, TLT. And when you look at that yellow box, everything was negative, down 2% or more. Some even up to close to 5% last week. That's a big loss. So, and then in the pink box, this is what it looked like for the past year, or this past year, back to January 1. And yes, there are some that, like the NASDAQ and the S&P, up over 20%, and then it drops off, and then it goes negative with developed markets and, of course, long-term government bonds down 10%. And what this is saying to me is that 60-40 portfolios, stocks and bonds, and stocks, by the way, are not necessarily in the top two. They are diversified typically among different types of stocks, sizes and types, value and growth, and large cap, small cap, etc. And so probably, those might have I would say maybe an average rate of return on typical portfolios of somewhere between 10 and 15% on the equity side. On the bond side, they're not all in long-term government bonds either. They are sometimes in corporate or intermediate term government, corporate, maybe even municipals, a mixture. So those are probably not down as much as 10%. Maybe they're down between somewhere 5 to 10%, but negative probably. And so when you put those two together in a 60-40 portfolio, this year, for the entire year of 2024, you're not looking at very much rate of return, probably something in single digits. So if you're in a 60-40 portfolio, you know what I'm talking about. You're not out there talking about 10 to 20% rate of return. It's not there. So that frustrates people. So to the right of this are the indicators showing, are these indexes above or below their 20-day moving average? And if it's red, it shows it's below its 20-day moving average, green above. So yes, the top three, yeah, they're above in a few cases. And then you start to get into the small cap and below, it's extremely negative. So that's why you're seeing the numbers to the left in the yellow box that you are. When you take the S&P 500 and you break it down to its component parts, these are the 11 sectors that make up the S&P 500. So again, the yellow box is this last week, all negative. It's very unusual. Sometimes you'll find defensive sectors that will, maybe one or two, energy or utilities or something, that'll be positive. Everything got hit. So what was down the least was technology. Everything else was down between 2 and 5%. So pretty big loss for this last week. It brought the year-to-date numbers in the pink box down some, so you can see those to the right. Everything is positive, but when you get to the bottom, the last four, barely positive, almost break even. So to the right, red dots, green dots. So the red dots tell you what is below the 20-day moving average, green dots above. But a lot of these, and particularly those last four, healthcare, real estate, energy, and materials, extremely negative. So, and there were, out of the 44 potential positive numbers, 44, 11 and 4 moving averages, 17 were positive. Last week, 26 were positive. So it's definitely been moving in more of a negative direction, particularly in the broad market. What happens a lot of times is that people are focused, or some investors are focused on the Magnificent Seven. You know, what is Google, Apple, Amazon, Tesla, etc.? What are those doing? That's a different story than the entire market. And there are people who are invested in those, in the Magnificent Seven or some combination of them. And they're experiencing high rates of return, consistently high rates of return. But I'll just tell you, that won't last. And I will even go so far as to say it will crash. I don't know when, but they just don't last. Nothing does. But right now they have been doing well. So, but the broad market below that is not doing as well, and this chart tells you that. Okay, this is a 30-month view of the S&P 500. So you can see most of that period of time, the S&P has gone up and consistently up. And yes, there is a drop at the end. You can see that at the far right, which is what we just covered. But it is still above its 20-period moving average. And so it is still in a long-term uptrend. It has not broken, in my opinion, broken the trend line. So we're still moving up. It won't last, but it has lasted longer than most people have expected. I take that and I put it over on a candlestick chart, and you can see what that looks like. So the ones that are hollow candlesticks are usually more starting here and moving up, and those that are red are more starting here and moving down. So you can see that over this period of time, most of those, just visually, most of those look like they have been weeks where it has been moving in an upward direction. Relative strength. So the NASDAQ 100 as a numerator, S&P 500 as a denominator, when you do that relativity to the NASDAQ and S&P, it looks like this. Over this period of time, most of this 30-month period, let's say about 2 years of that period, the market has moved up. In the last year or so, it has moved sideways, up and down, but not really going up much or not going down much. So I would say that's basically a positive indicator showing the NASDAQ over that period of time has had more strength, since it's the numerator, more strength than the S&P 500. The S&P 500 is comprised of two broad categories. One is growth, one is value. When those are put on a relative strength basis, growth as a numerator, value as a denominator, when it goes up, that favors growth. When it goes down, it favors value. So it's done both, gone up and down. However, recently, you can see at the very far right of the chart, growth has accelerated. So just showing the last 2 or 3 weeks, maybe that's the last month, where growth has just taken off over value. Value are the old economy stocks, and they are typically, many of them are negative. They're below their 20 or 50-day moving averages, and they're pulling the market down, and that's part of the S&P 500, and it's definitely part of this SPY-V, the value denominator in this equation. But growth, on the other hand, the new economy stocks, the NVIDIAs and Google's, Microsoft, etc., those are pulling the market upward, and when you separate these out, growth and value, you can see the impact that growth has on the broad market. S&P 500. Now remember, the S&P 500 is the broad market. It's comprised of value and growth. It is all large cap, but it is value and growth. When you put a relative strength on it to show the difference between the large cap and small cap against the small cap index, IWM, you can see that the large cap, whether it be growth or value, large cap in general is pulling the market up, and it is much stronger than IWM, which is a small cap index. Long-term government bonds, I'm not a fan of bonds. I know probably many of you use bonds or bond funds. I don't particularly like them, and this is a chart that shows a 5-year period of time to show that over 5 years, what's been the direction of the long-term government bond. Now, you could say the intermediate term bond, or you could say corporate bonds, they're all going down. The long-term government bond goes down more, but the direction of all of those is the same. It's in a downward direction. As interest rates and bond yields go up, and those bond yields and interest rates tend to be correlated, as they go up, the price of bonds goes down. The problem with this is that people are taught in business schools that the way you allocate portfolios is you put some bonds together with stocks. 60% stocks, 40% bonds. Well, that worked a long time ago, and maybe over a long period of time it works, but it frustrates investors because they see the anemic returns they're getting in this market. Why? Mostly because bonds are pulling down the yield on stocks. And you might say, well, stocks are too risky to own by themselves. Well, that's another discussion. That there's a way to do that. I do it a particular way, but this tells me I don't want to own bonds. And there's plenty of people, starting with Warren Buffett and many, many others, who don't own bonds and don't think that they're a good investment. And this chart, in my opinion, tells me why I feel that way. The dollar continues to rally. I draw a black line. This is a 4-year chart, a black line showing the direction of the dollar. Wow. So when you look at other currencies, whether it be the euro or the yen or the British pound sterling, they're, they are relative to the dollar. So in other countries, when you're spending dollars, you're from the U.S., you're spending dollars. That dollar is going a long ways. However, when they come to the U.S. or they're buying things from America, their currency is not going as far. Gold has a little bit of a pullback. It's been going up over, this is about a couple of year period of time. Goes up and down. This week happened to be slightly down, but it's still barely above its 20-period moving average, but is still in an upward trajectory. Silver is more volatile and is below its 20-period moving average, and I still think it's got an upward trajectory. It's just more volatile. Bitcoin also had a pullback this week, and but it has, over this probably 2-year period, had a general upward trajectory. Because the negative, I started out with a slide showing how negative the market has been. Because the market has been down, the volatility index, the VIX, has been up. It moves generally in an inverse relationship to the equity markets. So you can see at the far right of the chart the spike up from down around 13 up to around 18. And I drew a black arrow to just show the short term over the last 6 months or so, the short-term direction of the market, or of the volatility index, excuse me. The Asbury 6, these are metrics that measure the direction of the market. All 6 are negative. Last week we had 3 that were positive and 3 that were negative. Again, showing that the impact of a negative equity market on these metrics. Cross-asset relative performance chart from Asbury. I look at the ones that have all 3, the weekly, monthly, and quarterly. The only one in the equity category that has all 3 is large cap is stronger than small cap. The last week, the last month, the last quarter. All the others are mixed. When you get to the bonds, no matter how bad the government bonds are, and I just showed that to you, corporate bonds are worse. So green boxes for government bonds over corporate bonds, corporate or government bonds win out. High yield, better than low yield, or you could say high yield is better than high quality. Short-term bonds are better than long-term bonds. Now, this is interesting. There are no green boxes on here. There are no categories where there is one green box, and there's certainly none where there are 3, weekly, monthly, quarterly. In almost all cases, the U.S. market, led by the Magnificent Seven, is stronger than almost all of these. Stronger in all 3 categories than Brazil, Peru, Canada, Mexico, Switzerland, Italy, Spain, France, UK, Eurozone, Malaysia, Japan, Hong Kong, Singapore, Taiwan, South Korea for sure, and India, and Thailand, the Pacific, and Australia. All 3 categories. So this is driven, the market is strong, the dollar is strong, but especially in the market, the Magnificent Seven are, because we've seen the breakdown. When you get below the surface and you look at the other kinds of stocks out there, the other the other sectors, you realize things aren't that wonderful in the U.S., but when you get to the technology and particularly the Magnificent Seven? They are. But that's driving this. Other countries, just like, say, our value stocks, not doing as well. I compare the U.S., the market, not the economy, not the currency, but the market, the U.S. to South Korea, because it has more consistency in this chart than other charts. So it shows that the U.S. is doing strong, but if you did the inverse of this, it would tell you how poorly South Korea is doing relative to the U.S. A lot of countries are like this. It's just this one has more consistency to it. Gold and silver. So as of last Friday, December 20th, the gold, the spot price was $2,626, and that is a decline of 1.1% from the previous Friday. Silver, $29.75, $29.75 per ounce, generic silver, down 3% from the previous Friday. The gold-silver ratio, 88-1. A monster box of silver bullion is $15,440. So you can buy it by the sleeve tube or individually, or you can buy it by the monster box. But that's the price of a monster box. 500 generic rounds, 1 ounce each. This includes a $1.13 markup. Do you remember a couple of years ago, a little over a couple of years ago, when the markup was as much as $5 an ounce? I remember that. It's not that long ago. And you get to the Silver Eagles. I remember Silver Eagles were $10 an ounce markup. Well, here we are, $1.13. It has come back to earth. You know that wasn't going to last. That was kind of a frothy euphoria. But the cost per round, including the markup, is $30.88. Furnished to me by my son Preston, who's in the precious metal business. Okay, well, thank you for watching. If you have questions or comments, leave them in the comment section below.